Hi, welcome back. You're watching Midcap Radar. It's a bit of weakness creeping into the market this afternoon. But overall, if you see, there are, a lot of variables actually that are stacked up for the year. There's, of course, some slowdown happening globally as well. So that remains top of mind for most investors. And for our own market, the budget and election remain the key triggers. How do you approach the markets then? Dhananjay Sinha of Emkay Global Financial Services joins in. Hi, Dhananjay. Good afternoon to you. First up on the market itself, given the way earnings are shaping up, there's of course budget and elections lined up in, of course, a global backdrop of a potential slowdown that's brewing. What's the sense on the market?
So I think we have maintained sort of a range of about 10,400 to 11,000. That's the range that we've been maintaining since November, and more recently we believe that the risk is on the downside. While the lower end is at 10,400, it could be even lower. So I think the risk is on the downside at this juncture. I think the factors that are sort of contributing to this risk are basically the global developments to be the first set of stuff that one is looking at, be it the slowdown in China, the Brexit, and those kind of stuff. And apart from that, there is a sort of a lingering sort of a drawdown in the dollar supply. So US dollar supply has actually been coming off from the lag impact of rate hikes by Fed and also contraction in the balance sheet of the Fed. So I think those are the things that are there. Domestically, I would say, the uncertainty with respect to the election, the budgets, and the slippage on the fiscal front, all these things are sort of creating uncertainty. And hence, I think that's the domestic macro factor. And if you look at the results, I would say while initially there were surprises on the positive on the IT side and also with some of the consumer names, auto numbers have actually been weak, and that is reflecting in the results of the companies. There is sort of a downdraft in the margins of various companies. So those are the things that are weighing. So put together all of that, I think the downside is what we are looking at. So the risk is definitely on the downside at this juncture.
Dhananjay, fair enough. Risk is on the downside of the juncture. Your report, which you released, essentially says that talks about profit buoyancy in the US, which is in contrast with recession worries, and you're making a comparison with India, where growth has been strong, but there has not been a profit growth. Can you briefly explain the thesis?
So essentially, while there is a worry about an imminent recession in the US, and that's reflecting in the yield curve, with the short-term yield is actually reflecting a sort of a deflation or a significant recession in the US markets. In contrast to that, what we are showing is that US companies are growing stupendously. So their profit growth for 2018 is going to be about 20%, and in the second half it's going to be about 25%. And with what we have seen over the last 60 years is that the profit growth cycle is followed by higher investments, and that is followed by higher compensation. And roughly there are lags of about 8 quarters for investments, another 13 quarters for compensation. So in the context of the recessionary fears that have been there, I think what we are saying is corporates in the US are in a very strong footing, so are the households there. And as a result of that, we believe that there is going to be a continued traction as far as investments are concerned in the US, and roughly about 27% of that comes from IT investments by US companies. Going forward, we believe that as from the peak levels of 20-25% growth that we see in US profits, that's going to taper off as the impact of tax benefits wear off. But with the kind of cash flow that is there, with the kind of strength in the return ratios that are there, we believe that US companies will continue to invest, especially in the IT names, IT spending, and resulting from there, we think that the buoyancy that we see on the IT space in revenues will continue. So we are sort of positively inclined towards the IT space, especially in the context of the broader market view that we've just spoken about. And we think that rupee will also depreciate, so that sort of reinforces our thesis. So overall, IT space is going to give a return of about 13 to 15% over the next 1 year. Then hence we are sort of overweight by almost like 180 basis point over BSE 200 index. So I think that's one aspect that we're talking about. The second aspect that we're talking about is the comparison with US and India. So US corporate profit to GDP has risen to almost like a 80-year high at something like 11%. In contrast, in India, we have seen it declining to something like 3%. So we are seeing a sort of a reverse decoupling wherein India is actually showing lower profit growth versus the US. And if you look at the ROE of let's say BSE, S&P 500 of the US, that is at a high of something like 16%, whereas in India it has actually come down to 12%. So overall, in this context, with the kind of spread that return ratios give over risk-free rate, we believe that the private capex cycle is going to be lagging in India. It will still take a lot of time. So you have a contrast scenario of US companies investing a lot in fixed investments and in IT, whereas in India, I think companies are still sort of lagging behind, and they might continue to lag behind as far as private capex is concerned. So we are underweight on the private capex and capital goods cycle.
Dhananjay, thanks very much for joining in. In fact,